Good morning, everybody. This is Rob. I'm with the Bundy Business Solutions. We are a strategic business advisory company that does the accounting, bookkeeping. We provide tax return, as well as CFO advisory services that focuses on looking out into the future. And those can be with mergers and acquisitions, acquisition strategy, exit planning, forecasting and budgeting, and treasury management, that sort of thing. Today, I'd like you to think about, you've all been in your business for some time. Look back to the time when you started. With the experience that you have today, what would you have done different? So as I look back in my business, and look back to the beginning, there are some investments that I probably should not have made because I take on debt to do that. And so then now I'm stuck with that debt. So those are a couple things that we're going to look at today, is some of your leverage ratios in conjunction of what we looked at yesterday with your current and quick ratio. So this is always a function of liquidity in the organization, and it's a function of your treasury management and cash flow. So looking at those ratios is kind of important. So the first one we're going to take a look at is your debt to equity. So remember our accounting equation: assets equal liabilities plus equity. So when you start your balance sheet, you have assets, you're going to have total assets, you're going to have your liabilities, you're going to have your total liabs, then you're going to have your equity. And then in this example, we're using Tesla as our example. And in our total assets, those were 426. And then our total liabilities were 33,302. And then our total equity was 39,851. So these are the numbers that you need to have. So again, our assets, you can have your current assets, you can have your total assets. Current assets, then long-term assets, and your total assets. Liabilities, you're going to have your current liabilities, your kind of long-term liabilities, and your total liabilities. And then what's left over, the difference between assets minus those liabilities, is going to equal your equity. Okay? So to calculate this, we really take our debt, which is this 33,302, and then we divide that by our equity. Which that's going to give a pretty small debt to equity leverage ratio of 0.84. Now, bankers want this number to be low. However, investors want to have a little bit higher leverage in the organization to maximize the return, because when you leverage things, you're going to get a better return on the amount that you have invested. Second calculation we're going to make is your debt leverage ratio. So this one takes into consideration the balance sheet, but also the income statement. So what we want to calculate here, this is going to be your total debt, which was our total liabilities are this 33,302. But then we pull from the income statement to get that EBITDA. And now EBITDA is going to be your earnings before interest, taxes, depreciation, and amortization. So if we go down on the Tesla income statement, after our operating expenses, that's typically going to be your EBITDA. But what's also included in this are some things that we want to take out, is the depreciation and the amortization. So that number, when I added it all up, came out to 638. So if I take this and I divide that by this here, my leverage ratio is 2.63. So that's another leverage ratio. And the lower that number, the more liquid and the more likely that a banker or some kind of financial institution will want to provide you with capital, because it looks like you're going to be able to repay that loan with no problems, or at least service the debt. Going into the deep dive is so important to have all of your financial statements as accurate as possible, to be able to make these kinds of calculations to give you clarity on your entire organization. We do that as a company. We work with our clients and we do that deep dive analysis. So click on that link below and let's schedule a time to get together to complimentary consultation, and I'll look forward to talking to you then, okay? All right, bye.